All right, I would like to bring my, my speaking panel up on stage. Maex and Joselyn, Gvantsa and Ankush. Thanks, come on up. Thank you. Okay, so off to the beginning of the second half of the day. So delighted to kick it off with an investor panel. We're going to be talking about the dynamics of investing and how they've changed given the sort of new technologies and new capabilities that we have in the world of Web3. And of course, first we're gonna do some introductions so you can get the lay of land from where my guests are coming from. And so why don't you kick it off?
I'm Gvantsa. I'm head of portfolio fundraising and tokenomic structuring, and I work at leading Web3 accelerator, Outlier Ventures.
Outlier Ventures.
Hi, I'm Joselyn. I'm the head of Luno Expeditions. We're an early stage fintech and crypto investor globally. We're part of the digital currency group.
Okay, hi everyone. My name is Ankush, and I'm the chief investment officer and co-founder of Aaro Capital. So we're running a set of fund-to-fund strategies investing in crypto funds. Over the past 4 years, we've talked to over 1,000 funds, so I hope there's going to be some interesting perspective on this panel.
Yeah, hi, my name is Maex. I think I'm wearing two hats today. I'm the founder of a protocol called Centrifuge, where we provide credit to real-world assets on chain, and I'm an early-stage investor as well.
Great. And so while we kick it off, could I get you to pull up our Slido poll, please, so that we can get a feel for the audience? We did this earlier, and when I was interviewing Lex. This is just one question. So. Question for the audience is, how long will the bear market last? I think we all recognize that we're deep into a bear market, and the question is, how long is this going to last? The results will be dynamic. Don't let those influence your vote. So I've got a great panel here representing the entire breadth of the investment market, from the fund of funds all the way down to beyond the venture investor, down to the angel side, and an entrepreneur as well, wearing two hats. So question one for the panel is, what are you seeing today, and what's captured your creative energy?
Maybe I can start on what we see at very early stages. I think being an accelerator and the volume of the applications that we get enables us to have a market insight on the market earlier than many of the other investors. And there are a few themes that we currently see. For instance, in the consumer space, there are a lot of brands right now really interested entering Web3 space, and they're very much interested in NFT consumer place. We see a lot of interest still in the infrastructure, in the developer tools, scaling solutions, ZK, and then interoperability solutions. We also see a lot of interest still in the DeFi sector, very much focused on bringing on the applications that bring institutional investors on chain. And then we see some of the changes on the fundraising front as well, from where things were like a year ago.
Yeah, we are quite a global investor, so about a quarter of our portfolio is here in Europe, a quarter is in the US, a quarter is in Africa, and a quarter is the remainder, Australia, India, et cetera. And I think we see a lot of emerging use cases for crypto quite globally as a result, because we have such a global lens. So if you look at the top 20 countries for crypto adoption by percentage, not by dollar, those are countries, 18 of those 20 countries are countries with high inflation, high currency devaluation. That does not include the UK. So if you include the UK, that could be 19 out of 20. But we think there's such a great use case for crypto in emerging markets. So we see a lot in stablecoins and remittances, just in cross-border payments overall. We really think it's a killer use case for crypto.
I might just add, I'm actually pretty interested in seeing the results of the poll because
Yeah, actually, Emily, if you pull up the results, that'd be great because we could. I'd like to see those results as well.
yeah, sure. Because I mean, we talked to a lot of crypto funds, and as time has gone on, these crypto funds have become much more fundamental and much more rigorous in the way that they approach their analysis. And at the moment, I mean, the market's fallen a lot. It's fallen like 60, 70% from its peak. Some funds are still very bullish. They believe that crypto is going to decouple from macro. It's going to do extremely well over the next 12 to 18 months. And some funds, which are like ex-traditional finance guys, more quant traders, arbitrage, they're very bearish. They think that crypto is not going to decouple from macro. It's still going to be very weak for 18 plus months. I noticed on the poll, only the minority believe that crypto is going to recover anytime soon. So that's something that I find very interesting because 2-3 years ago, pretty much every fund was completely bullish. Now the views are a bit more divergent, which perhaps reflects a more mature market.
Max, did you have any comments on sort of what's bringing you into the venture world and what's got you excited?
So sure, yeah. I mean, maybe I start with the centrifuge world because
For sure.
There's a couple of things that changed in the last few months, 6-9 months. I mean, just maybe one word what centrifuge does. In centrifuge, we tokenize real-world assets, put them on chain, and provide financing for them. So as an investor, you can finance in those real-world assets. Real-world assets for the crowd outside of blockchain are called assets. Just forget about the real-world part. Examples are invoices, mortgages, or carbon credits. And there was not a lot of interest, let's say 1 or 2 years ago, in that asset on chain because the returns were just not double-digit or even triple-digit as we saw in some of the crypto investments. The last 6 months that obviously changed. Investors like staying on chain and then invest in pools that provide them with 6, 7, 8% on pool, a little bit more than a stable coin, an asset they understand. So we see quite some inflow there from institutional as well from retail that want to put their coin, their stable coins into real-world assets. And on the early stage VC side, where I'm angel investing for the last, let's say, 2 years, some things that excite me, oops, I shouldn't do that. Some things that excite me are regenerative finance. So taking the concept of DeFi and applying it to climate problems, carbon credits on chain, carbon futures, like financing projects. I'm quite excited about that. And the other topic that's actually accelerating, I think, these days is something which Multicoin called the proof of physical work, where you use token economics to reward for real-world actions. Providing your Wi-Fi to someone, use a dash cam to record something, and be rewarded with tokens that are then purchased by others. So yeah, those are some of the items.
So what I'm hearing there is a real collision between again, sort of like the whole concept of the conference, for us, the merger between traditional finance, fintech, and Web3 is appearing, but it's both in the consumer applications, like you mentioned. It's also in tying things back to the real world, and then it's all the infrastructure that's happening. And what you're bringing up, Ankush, is crypto in general going to be a risk on, or is it risk off? And like Ethereum, will it decouple from the movements in the stock market, for example? So like we've got this really dynamic space. Now, as investors, like I've got 1,000 questions for you, but it really comes down to where's the value going to be captured? Like where are you, outside of like the kinds of companies that you were investing in, how are you investing in them? Because that's changing too, right?
Yes, 100% you're right on that. So I think the key question there is always, what is the business model? And we see equity-only business models, we see token-only business models, and then we also see both of the business models. Although with one caveat that it's much harder to run the two business models in parallel, because the incentives there are not really aligned. Are you maximizing the value for the shareholders, or are you maximizing the value of the network? But what we've really seen in the past few years, when, for instance, last year this time, there were a lot of token projects out. The rounds were oversubscribed, the valuations were all-time high. And now what we see more is equity plus token. And that seems to be the most prevalent way of doing fundraising right now. And probably because being in the equity also is de-risking the project for the investors. And if the token economy is not fully fledged out, it may be better path to take equity position as well.
I'd love to hear your thoughts on that. And also, is there any geographic diversity? So like you said, a quarter of your portfolio is in Africa. Are you?
A quarter.
Yeah. So is that are you seeing anything different in those different geographies?
Yeah, I guess on the first point, very much. We are equity investors. We're part of DCG, which does do token investing and does do special situations and later stage equity, but Luno Expeditions is equity. And I would say very much, a year ago, earlier this year, it was a lot of tokens. Even at the very early day zero stage, and now we are moving more of an equity plus token warrant or safe plus token warrant. And I think the reason for that is, in our view, a token doesn't necessarily make sense at day zero. It's a great tool to bootstrap liquidity. It's a great tool to have the flywheel to bring more users in. But if the token isn't worth very much at the very beginning, because there aren't a lot of users in the platform, you bring people in, you're trying to incentivize people, the token that's worth like 0.01 cent, right? Like it's not very incentivizing to have that token, and so we don't actually see as much these days token at day zero, but once they hit sort of early product market fit, it makes sense for some of the businesses, and that's why we prefer to invest in an equity or a safe plus a token warrant, because over time we can see the business model evolving to incorporate a token in many cases, but we don't know how that token's going to be structured, or we don't know when, and so since we do equity initially, we prefer to couple it with a token warrant to allow for the eventualities of tokens. And to your geography point, Bo, it's a good question. I think we tend to see more tokens in what I would call like Web3 native businesses, which for better or for worse is not as prevalent in places like Africa. In places like Africa, we do see more use cases, as I was saying, around stable coins, around payments, around exchanges, crypto as a speculative store of value. So those don't tend to naturally lend themselves as much to tokens. But in places like India, we see more gaming investments. Those have more of a natural token component. So it really depends what geography we're talking about.
So I'd love to get your thoughts on this as well.
Sure.
And I think you were going to bring two very different perspectives on this. Before I do that, I often make the mistake of assuming people are super facile in the language that we're using. I'm a complex securities valuation analyst. I'm a former venture capitalist in Silicon Valley, and I run a fintech conference. So this language is very, I love this language. However, what's happening here is we're talking about the move from the traditional equity and debt structure of a C Corp founded in Delaware, which is like every company between 1970 and today was always founded that way, and the move to a very different idea, which is there's value in the equity, there's value in the debt, and oh, by the way, we're creating this currency or this asset that's a token that we can issue that may also have value. And so the question is what do we fund? Do we fund the equity and the debt like a traditional C Corp, like we're VCs, or do we put money in the token on day zero? And that's, so just for those of you that are totally lost, that's what we're trying to, that's what we're trying to just crack here. Short answer I think you're going to see is that we haven't figured it out. So please dive into that and help us unpack what it means as a fund of funds investor, and then also as angel VC / entrepreneur, and what you've seen and done.
Yeah, sure. As a fund of funds, we take more of a top-down view of things, so it's much more based on economics. And we view like the valuation of a token to be based on economic assumptions or economic fundamentals. It's all about incentives, supply, demand, network effects, whereas the valuation of an equity is more based on financial assumptions. So past earnings, future assumptions on possible dividends or earnings in the future. So there's a bit of a mix between the two, how we think about things. In terms of our exposures, so some funds focus purely on tokens. Other funds, like venture capital funds, might focus purely on equities. And then there'll be like a mix in between. So some funds focus on both. Most of the funds in our portfolio purely do tokens. And the reason for that is that they're much more liquid. You can sometimes get the same return as a VC fund in a much shorter span of time. But the disadvantage is that there's a lot of noise in the short term. So very often a token will launch. It's got amazing tokenomics, but the underlying business just doesn't make any sense. So there'll be like a bit of a mismatch between token value and business value, and vice versa. There could be terrible tokenomics, incredible business model, token value either super high or super low, depending on what you think of it. So there's pros and cons. I think in most cases tokens don't really make sense from day one, but in Web3 sometimes it does. Sometimes when the business model is underpinned by a token, and when it makes sense to launch a token that underpins the revenue of the business, then that's one of the key ways to go to market, to build a community, to just get started and start building the revenue from there. But the way we see things as investors is to diversify. So have some tokens, have some private equity, public market equities. You have different risk and reward profiles, and then you get the best of every world.
Max?
To Gvantsa's point, I mean, it highly depends on the business model that a startup or a project has. Some might need a token from day one, or at least a plan how the token should look like from day one. If it's a layer 1 or layer 2 blockchain, yeah, probably a good idea to think about the basics and the economics. But the vast majority of projects that I see, that I work with, I mean, it's even for me a warning signal if they come already with a fleshed out token economics white paper and a pre-seed. This just doesn't seem right? They don't know yet the details of their business. So personally, it starts as an early stage investor, always with an equity investment, whether it's a safe note or a price round, whatever it is. And then, depending on the business, a conversion at some point into a token. That's what we did at Centrifuge as well. I mean, 5 years ago, we could have done an ICO launch. If you guys remember, it was pretty fancy, 2017, to do that. No, we did a very traditional seed round from very, very reputable investors here in London and elsewhere. And then over time, launched a token just a little bit more than a year ago, so 4 years into the company, and decentralized step by step. It has a couple of advantages to do that way from an entrepreneurial perspective. If you launch a token very early on, I mean, you have a community that decides then. You have a DAO. You have, that decides on your roadmap, decides on your parameters, decides what markets you go to, and it slows you down. So you got to pick the right time when you actually launch a token in order not to fail in terms of speed.
Let's use that as a little bit of a case study. So you founded in 2017, or raised the angel round or first round in 2017.
That's right.
Last year, so 4 years later, you launched your token. Why did you launch the token at all, and how do we look at the combined value of token plus equity? Is that how we should look at enterprise value?
Didn't know about that. For us, from the beginning, we worked with, on the seed round. Although we didn't know how the token economics would look like, it was very clear, and we communicated it with our investors. There will be a token at one point in time. The equity will be worthless, and the value of Centrifuge will be in the token. And that's exactly what happened. So the centralized entities are no longer relevant. The value is in the token. There was a distribution to the early investors. Obviously not the same as the equity,
So you
but part of
dissolved
it.
the equity claims. Essentially, the equity claims dissolved into the token.
That's right.
Okay, got it.
That's right.
Okay.
Well, and to be fair, we're fantastic investors early on, so they were with us along the way to figure out how the distribution is. It's not always the case. Sometimes you want to, in early stages already, somehow write down what this conversion should look like in a token warrant or token side letter. sometimes complicated because it's just not clear how the network will look like. So we got fortunate having great supporters that were very flexible with us. But in essence, that's what we did. We launched then the token 4 years later together with them.
Perfect. I'm going to jump right to audience questions because I think we're going to get some great questions coming directly from you. Thank you for jumping on it already. The most upvoted question right now is, and by the way, if you're not familiar, use this QR code to ask questions and interact with the other questions that have already been asked. So what are the most crucial aspects to good tokenomics? This is for the whole panel, and it's a new skill set, I think, for all of us.
I'll try to answer that
Give it a
question. Well, I think it's more of an art rather than science, but we see clearly certain things that seem to work better than the others. Now, maybe I will take a bit of a step back and first ask the question, why is this even important? Why do the founders from the outset need to think about their tokenomics? And I think it's from the outset, it's very important that you understand who the stakeholders in your token network are. And how does the allocations of these tokens go with the different stakeholders? And then also, what is the supply of the tokens in this token economy? And how does cliffs and vesting affect the valuation and the way the circulating supply will turn out over the long period of time? And
now,
this is
on that case, in terms of the supply, you're also trying to match demand, right? So it's really, it's not just the rate of, you're trying to match the rate of supply or let supply be lower than demand, right?
So that's where the art comes in, because at the end of the day, it has to reach the state of equilibrium where the supply meets the demand. And the good design of the tokenomics means that the supply that comes on the market in terms of the cliffs and vestings unlocking then is met by the demand for the product, for the service. And it's very important that the tokenomics and the way the circulating supply and emissions come onto the market is timed well with the product milestones, roadmap, and the demand being there to take that extra supply from the market.
So I am not an expert at this, but actually your colleague Charlotte at Outlier Ventures said something to me once that was really illuminating, which is I said, tokenomics, like what is this thing? I don't get it. And she said, think of it like an equity raise. Like if you were to do equity capital markets, if you do an IPO, what's the green shoe? What's the insider allocation? What's the vesting schedule? How much you're going to sell on secondary, and then think like if you're going to do a further follow on. And then I was like, oh, I get that. That's one thing I understand. And then just think of the same principles under applying to tokenomics. So Charlotte's comment was very helpful to me, so I'll just share that with all of you.
We know we're at an actual fintech/TradFi conference if we use the word green shoe on stage. So
and
thank you for
relevant to
anchoring,
tokenomics.
Thank you for anchoring us. Does anyone else want to jump in on this?
No, I think Gvantsa said everything.
Yeah, I could say that there are many similarities to just how businesses are run. For example, if a board of directors wants to issue more shares, that will affect the supply. Similarly, when you look at a token, if there's a set schedule for issuing more tokens or burning tokens, that can have an impact on things. And then comparing that to the demand as well is a big factor. But I'd say one of the biggest things that we see amongst crypto funds, they're always looking at incentives. Like Multicoin is a great example. Proof of physical work, investments into things like helium, where you have a helium token. How is that incentivizing people to maintain the network, to use the network, short and long term? That's a very big factor. And then as time goes on, it gets even bigger when you have larger and larger network effects.
Yeah. Let's tackle the next question. Okay. So how would you advise crypto Web3 startups to separate their revenue and valuation when raising from the price of the blockchain or cryptocurrency they use? Let's see if we can restate that and understand it a little more clearly, because I don't think we can ask the anonymous asker. So we're coming from the perspective of a startup, Web3 startup, entrepreneur. We're trying to separate out the valuation from the price of the token that
So
they
this
use.
assumes a startup or a project that has already launched a token
Yes,
and
I
is
believe
now
so.
trying to raise money. I mean, there's not a lot of options because the token's out in the wild and has a price. So
Right.
if I understand the question right, I mean, it's like if you're a publicly traded company and you want to raise money, the market sets the price.
Right, yeah. I think that's a good answer. Does anyone else want to comment on that?
If I understand the question maybe correctly, maybe the question is, how do we value equity versus how are we valuing token? If that's the case, then I think that's again the question of the business model. Where does the value accrue? Does the value accrue to the shareholders of the company? And then we are valuing the equity business and whatever the business model there is. If we are looking at the token and the value then accrues to the holders of those tokens, then we're looking at the network volume and the activity. And we are valuing then the network, not the operating business. And, you know, there are different ways of doing that. Maybe I will not go into the detail of those, but you would do it separately.
Okay, fair enough. Let's see, next question. We see narratives come and go, DeFi, metaverse, and gaming being examples. What is the perpetual narrative that you keep investing in?
I think for us, improving mass adoption of crypto is a huge one, and I think a lot of investors talk about this. You know, how do you actually bring the next hundreds of millions, billions people onto crypto? And for me, you know, they could be actually using crypto, like they open a wallet, they buy an NFT, great. They could also not be using crypto. It could be explicitly, it could be they're using something powered by crypto. So if, for example, remittance companies, you know, you may not need to know that it's actually powered by a stablecoin. You know, they're using stablecoin rails to keep it cheaper and to have more instant settlement. The user doesn't need to know, right? They don't need to know their seed phrase. They don't need to know anything about crypto in order just to have money arrive cheaper and faster. So yeah, that for me, perpetual narrative would definitely be mass adoption, but not just in getting people to onboard themselves to crypto, to have the technology infringe multiple parts of multiple sectors, including, say, refi, for example, is a great example.
I think very, very similar with us. Our thesis is to bring the next billion users onto Web3. So we invest in everything that is helping with the open metaverse.
Well, for myself, as an early stage investor, I think the recurring theme, if there is one, is that it got to have a real world impact. So whatever, the crypto casino thing that happened the last 4 or 5 years was helpful, I think, to build the infrastructure and build some tooling, but it's not what I'm interested in as an investor now. I'd like to see some of the things that are done with crypto, in crypto, have an impact in the real world. Get loans to SMBs in need, in refi to project developers, so there got to always be this real world impact.
So from our perspective, there's two narratives that will never change. I mean, one of the narratives is that long term, there's like a set risk and reward from investing in this asset class. And regardless of what the short-term narrative might be, whether it's DeFi, metaverse, gaming, we want exposure to all areas. And we want exposure to that long-term development. As time goes on, it'll become more real world, just like you mentioned. And then it makes more and more sense for investors. And that's the narrative of many banks and asset managers. That we talk to them all the time, and it's all about risk and reward. And then in the short term, the short-term narrative, the second narrative, is that this is a very inefficient market. So sometimes the token values don't necessarily represent the value of the underlying. And that's a perfect opportunity for arbitrage or short-term trading strategies. So the long-term narrative will always be there. The short-term narrative, for now, it's presenting many profitable opportunities. And in the meantime, there might be many narratives in between, sometimes for a few months, for a few years, but it's all feeding into those two key narratives.
Understood. Let's tackle the next question as well. It brings us back to tokenomics. And this is looking for an analogy. So is tokenomics similar to a closed-end fund in terms of the independent movements of value and price? So does anyone want to tackle that, or should we dive a little deeper into the analogy?
I think it probably depends on whether we're talking about fixed supply or we're talking about inflationary models. And then there are things like mint and burn mechanisms as well. So tokenomics of those, all of those things vary because you get at different points in time emissions, or you are able to reduce the supply, which will then have indirect effect on the price.
Right, so the closed-end fund analogy might work in the case where you had a fixed supply and there's a box that represents a value, and let's say it's an agriculture box, and so it's all the farms are in that box. And then you've got a fixed number of farms in that box that are producing economic value. Then that's the value of the entity. Then the fund price may fluctuate based on whether or not the market appreciates the value that's sitting in the box. And what you're saying is that works in some senses, but we've got a lot more flexibility here in terms of how we design what's in the box. We can create more essentially shares. We can create more assets inside the box based on the sort of design of the box itself.
Yeah, there are many aspects I would say that would increase value of the token, and those things are network fees and how these revenues are tied to the use of the token. Then there are things like mechanisms, the design mechanisms, staking or burning. Then there is the governance. And then there is the supply. Is it fixed or is it not fixed? So I think all of these parameters affect the value of the token and tokenomics. How is it used?
Here's an interesting one. With the price of energy skyrocketing and climate change ever prevalent, what more can be done in the crypto space to promote ESG values?
Well, I mean, a few weeks ago, we just had the merge, where the Ethereum blockchain went from proof of work, that's the energy consuming one, to proof of stake. So I felt that this argument of, I'm not sure if the person that asked the question is hinting there on the energy consumption of chains, but the last blockchain that actually is using proof of work relevant blockchain is Bitcoin. And there's a lot of arguments to be made that actually there are ways of the fact that Bitcoin can be used in combination with renewable energies, where renewable energies have their ups and down times. Bitcoin mining can actually make renewable energy production more
bankable.
Beneficial. Yeah, exactly. So that's one piece of the equation. The other one, and again, I'm not trying to shill my book here, but I'm going back to one of the areas I'm looking into right now, which is refi or regenerative finance. So if you ask me what blockchain or crypto can do, well, it's bringing this whole ecosystem of carbon credits, carbon futures, carbon offsets on chain to make it transparent, make it easier tradable, and with that increase the availability of carbon offsets to achieve our goals. And we can debate again if carbon offsets is the right way to go. I think it's one ingredient that is important, and I think crypto is helping with that.
So I used to be an impact investor for 6 years before joining Web3. So I've seen the rise, and I don't know, wherever we are, rise in current state of impact investing. And if you think about where, I'm going to take ESG in the broadest sense here, like ESG impact investing, came from, it started off by kind of a do no harm kind of thing, right? It said do not invest in tobacco, do not invest in gambling. And then that was kind of it went from being the negative screen to the more positive screen. And then it was embedded in more of the mandates. But the mandates really of institutional investors, right? Like the Harvard Management Company, Yale, those are the ones who really promoted ESG. I think and then over time, that was also because consumers were the ones who were advocating for having, they didn't want their money funding fossil fuels, they didn't want their money funding cigarettes, et cetera. And so I think, crypto is actually a really interesting inflection point here in that there is institutional money flowing into the space. However, it's by definition harder to say, do not do this, because it is so fluid in the space. But there is a huge role for consumers to do more in promoting whatever ESG values you want. Consumers to do more, having that pathway for consumers to say, well, I'm putting my money in this, I'm not putting my money in this, I'm putting my money in Ethereum post the merge, I'm not putting my money in Bitcoin. But then also to have that trickle to the institutionals, right? And to kind of say, hey, we only want our capital to be going to ESG positive crypto investments, because ultimately that's how change happens, is through the institutionals and governments, but we'll leave that aside out of this conversation.
One thing I want to ask, and this might turn out being the closing question, is really a qualitative one, and it refers back to what Amit Choudhury said from Polygon, who was on stage just before the lunch break, and he said, look, the thing that differentiates Web3 from other communities that he's been exposed to is the passion and the energy of the entrepreneurs. And I just wanted to sort of gut check that and see if, like, haven't entrepreneurs always been passionate and always been full of grand ideas about disrupting and rebuilding and creating a better society? Is there anything different here?
Well, I mean, I do that stuff for 20 years now, building startups. So I've been like right after the dot-com boom, and yes, you're right. Entrepreneurs, by definition, and successful ones at least, I think, or ones that want to change the world, are passionate. But that said, the last 3-4 years being in crypto, there is a different energy. There is a different can-do attitude. There is a different changing the world desire. Don't know why and where it comes from, but there is no doubt there's a different energy. If you go to pure crypto conferences, it's quite remarkable. Whatever the price of ETH and Bitcoin does, it's amazing how people build and
at highs and lows.
That's what I mean, exactly.
Right.
Not
Yeah.
specifically at lows, at highs, obviously.
Right. Highs are easy.
Yeah, right.
Yeah. What do you think?
I think it's partly because it extends across so many different industries. With this blockchain, or like centralized versions of it, or crypto, it extends across everything. So very often when you go to a conference, you see guys in suits standing next to guys in like Versace ties and pink shorts. And it's quite a big mix of people. And because it's, like you mentioned, because it can have such a huge impact over the long term, that's what makes people so passionate. And I think, any creative industry, any kind of entrepreneur is always going to be quite passionate, but particularly within crypto and blockchain, because it's such a big movement, I think you're going to get that additional passion, additional burst of energy.
I think in crypto there's such a emphasis on community, right? They don't say like my users, my customers, they say like my community. And I think that is a very different energy, to think of it as like your peers rather than the people I monetize from or the people that I'm selling a service to. It's a very different way of thinking about it, and I think a great one.
Gvantsa, you get the last word.
Maybe I will look at it more from philosophical standpoint, and I would say wherever there is centralization, the antidote has to be decentralization. And that's the movement right now.
That is the movement. Thank you so much for sharing your wisdom with us.